Portfolio Builder members, today is June 4th. This is our Diamond Club member update. Today the Fed signaled they may just lower rates due to the trade war and low inflation. And so the stock market bounced pretty heavily from that. Today's trade alert is to cover our covered calls, but we're not going to open a new covered call. The market is heavily betting on upside movement this week. And so I'm just going to let our underlying assets appreciate while we hold on to our hedge. Here's our recent string of covered calls. So you can see they've done a lot of protection for us during the past several weeks. And so to look at the trade alert, we are covering all these positions. We collected this column right here, and we are paying back this column right here. So all of them generated a profit, except for Intel. But of course, if we have to pay a higher premium to buy back a call option, that's a good thing. That means our underlying asset shot up in value. So Intel actually was the most profitable position for us this week. So again, no covered call this week. The only thing you need to do is own 300 shares of Microsoft, 100 in Apple, Facebook, Intel, Cisco, 200 Comcast, 900 in Bank of America, and 500 in Wells Fargo. I'll take a look at the option market in a little bit so you can get a feel for why we're doing that. But this is very important to maintain currently at least 5, and I would say up to 10 shares of the long put option for Apple. So this is buy to open 5 July 19, 2019, $150 puts. And this is not to protect just the Apple position. This is to protect us against a systematic crash in the equities market that would target Apple with the US-China trade war. So this is to protect and provide insurance for our entire portfolio. So it's very important, especially now that we're running for a week or more with no covered calls, to have this protection. So we don't want to sell call options right before we're expecting a huge move up. We'd rather do that after the huge move up has already occurred so that we can protect against downside risk and profit in 3 directions. So again, the Diamond program will take on a little more risk than the basic program because it's trying to deliver twice the return as the basic. So I just want to illustrate how well we've done protecting capital despite this pretty rapid sell-off. So we started off at 294 on the SPY and traveled to 278 for a 5.4% loss in the SPY from the peak until the current price right now. So the S&P 500 is probably the least volatile asset you could possibly purchase in terms of an equity-based ETF, and far less volatile than any individual stock. So now that we consider our portfolio is far more risky than the S&P 500, if we can outperform the S&P 500 during a downturn like that, that is the goal, and then to be positioned to generate higher returns than the S&P 500 when the market's traveling either up, flat, or slightly down is, in general, our strategy of generating profits. So right after a volatility spike is when we make the most money during a recovery or a flat move from there. So right now, I'm highly suspicious that the market will jump much higher. So that's why we are bypassing the covered call for this trade. Most likely by next Tuesday, we will add the covered call back in, but I think this week we don't want to sell the call option because the underlying assets are really setting up for a big rebound. So these are much more risky in their own because it's only a composite of 8 total stocks versus the S&P 500, which actually has 504 equities. And so we've been seeing a lot of money flowing out of tech into very defensive, safe trades. And I think that now these tech are all oversold, so it's going to lead to a big buying ramp up. And so we can see from the same period, we dropped as much as 14.2% till today's screenshot, which is now sitting at 9.9. So we lost about 4.2%. from the top to the bottom. And during that period, we had less. So most of that period, we lost around 3%. And so our covered calls have done the job. They took out a lot of the sting. They allowed us to stay in the market. If it hadn't dropped this precipitously on these different equities, we would have actually been generating profits during that period. But instead, we basically just muted the losses. We made it much less painful. And so now we're sitting at a 9.98% return. We're holding on to a small hedge, and potentially on June 11th, we will enter into the next covered call to protect a run-up. Now, if the opposite happens, if the market starts to break down, if we start seeing escalations between US and China in this specific week, we can immediately issue a covered call and add protection back to this. But let's just take a quick look at the options market now. So rather than look at the option market for each individual stock, which normally is what we do to choose our covered calls, right now I'm looking at the total market based on the SPY, which is the by far the most active option market and the most active equity in the world. And so we can see the volume is now flowing away from the put option market in terms of building up open interest. Let me zoom in on this. Okay, so what we want to pay attention to is both the volume of the day and the open interest. So open interest could have built up over the past few weeks and may not be quite as relevant, but where we see a buildup of open interest and we see a buildup of volume for that given day is a good signal. And so on this end, in the put option market all week, the 275 short put option, the writers of those put options had around 50,000 contracts sitting at the 275 strike. And now that the SPY has pushed all the way up to 278, you can see they are abandoning that position. And there's no huge buildup today in the open interest on the put option market. Now on the other side of the chain, we are seeing a pretty heavy amount of call option immediately flowing today. You can see there's only 5,000 open interest, but 10,000. So people were buying that call option and quickly selling it for a profit, pushing up the market higher. And now we're seeing the open interest build way up at the 280 level. So if the SPY goes up to 280, that's going to push all of our companies, which are the main benefactor of the SPY, up higher. So we can basically just look at if the S&P 500 is going to rise in value, all those funds are going to automatically flow straight into our core positions. So that's the open interest going into today's expiration. If we go till the next expiration, we can see that there's a similar buildup at the 280 with 26,000 contracts and 10,000 shares flying through this morning. And so the short-term move, at least for the next 3 days, which is where the dominant amount of option volume trading happens in this very short term, is all pointing up. So it's not in our best interest right now to sell call options. So to summarize, it's time to hold on to your horse. We're going to be riding without the normal protection we have, and this could be one of our biggest profitable weeks to date. Now, if things turn south, you know that I'm always the first one to want to be the Debbie Downer, the negative Nancy, the paranoid Patrick. So I'll be very quick to issue an emergency alert if need be to protect with a covered call on these positions. So if we see the market starting to head south, we will write a deep in the money covered call and take advantage of this higher level of volatility. So that's it for today's trade. Very easy, very simple. Make sure you do have your protection. Insurance never pays off until all of a sudden one day it does. Imagine going to the hospital and having to stay for a week and you didn't have the proper insurance and you're paying $50,000 a day to stay in there. Well, this little put option on Apple may lose all its value, but if a disaster does occur and the trade war really escalates, most likely Apple will be a prime target. It's the equivalent, it's kind of the equivalent of China's national champion Huawei, which is being absolutely economically destroyed right now. And so obviously this would be a very iconic company to go after for China to look strong in some sort of ramped up trade war. So it does look like there's a calm in the storm right now. We're seeing the banks starting to flood more money into the markets. We're seeing some of our smaller markets like the Kospi, the emerging markets recover. So I think until we get some more tariffs increased on China for the other 300 billion, we might have some pretty easy coasting here. So thanks again for your time. Tomorrow's trade alert for basic members will come out at noon. That trade for Monday is killing it, doing absolutely spectacular. And so we will continue the news today at the market close. So expect a nice 30-minute video covering all of our portfolios right at the close. Thanks again, and expect a new trade alert tomorrow.